Stock market crash, what should you do right now to earn money in the long term? Now, I've spent the past 10 years reading over 200 books, studying the best investors all around the world. And personally, I've also spoken in various hedge fund events over the past few years and studied the past 100 years of market crashes. What makes the difference between those who earn money and those who get nightmares every time the stock market crashes? Now remember, the most expensive sentence in the financial market is "this time it's different." It's the most expensive sentence that costs a lot of people a lot of money. Now here's the thing. Rationally, as investors, you're supposed to buy low, sell high, right? But because most investors, they like to follow the crowd, hence they would buy during the time when the stock market is very high, your neighbor is making money in the stock market, your taxi driver is making money in the stock market, everybody is talking about the stock market. It is during that phase, that time, when most people are going to jump into the stock market out of FOMO, fear of missing out. Whereas the top 10% of elite investors, during this time, they are going to sell off a lot of their stocks because things are super overvalued. Why would you pay $2 for a $1 coin? It doesn't make sense, but because everybody else is making money, I gotta jump in. End up, because of this irrational following the crowd behavior, a lot of people end up buying high. Then when the market crashes, they sell off out of panic. So 90% of people end up buying high, selling low. Whereas the top 10% of elite investors, you study all the past successful investors, even the successful investors in our time. I've read books written by Malaysian investors, Singaporean investors, American investors, Australian investors. Each of their country has their own top elite Warren Buffett level investor, okay? And they all have one thing in common, including hedge fund managers who make it to the top, who produce higher returns than other hedge funds. They all have one thing in common. They would buy when everybody is panic selling, when the market crashes. It's not like they could predict the market. Nobody can predict the market, including me. But when they buy at a low price, at a discount, the risk to reward ratio is on their side. It's like paying 50 cents for a $1 coin. Why would you not buy it? So why don't people do that? Because it is the hard thing to do. When markets are down, the news, the TV, everybody is preaching to you, oh my God, it's the end of the world. The markets are going to go lower and lower. And if you're a hedge fund manager, your clients are asking you, excuse me, why are you buying stocks when the markets are crashing? Do you not care about me? And when the markets are going up, the top hedge funds are selling off, their clients will ask them, excuse me, everybody else making money, why are you selling off my stocks? So even for institutional investors, it's the hard thing to do. For retail investors, for you, it's also the hard thing to do. Because when everybody else is making money, when the markets are going up, your neighbors will ask you, every one of us are invested in the market and you are not. Man, you're missing out on a lot of money, putting a lot of money on the table. You see how uncomfortable it is to go against the crowd? So when you see a market crash, it's like your favorite online shopping platform giving you a Black Friday promotional discount. Every time I see the market drop, I'm so happy because personally I like shopping, okay? I'll be so happy because it's time to go shopping. You study all the top investors all around the world. They have the same habit. But most importantly, don't just buy any cheap stocks because a lot of penny stocks go bust, okay? Make sure you buy undervalued companies that are good. Companies that can produce consistent earnings, growing earnings for the past 5 years. Increasing and growing free cash flows, increasing and growing operating income, and most importantly, make sure that they can sustain these earnings. And in order to do that, you need to make sure that the company that you buy has a strong economic moat so that they can withstand this temporary market crash or recession. The next hard thing to do is patience. Wait for it to ride out the bear market. It could take more than 1 year, but if you buy a fundamentally strong company, your patience and discipline is going to pay off. Because you know how most investors operate, applies to investors all around the world. They like to buy based on hot tips, based on friends' recommendation. And are their friends successful investors? Not really. If your friend is not a successful investor, why would you listen to him or her? Third thing, they like to follow analyst recommendations, which fail most of the time because a lot of analysts, they have conflict of interest. Even analysts are pressured to follow the crowd because it's better to be wrong following the crowd than to be wrong having your own opinion. Because if you're an analyst and you have your own opinion, and if you're the only one being wrong, you're going to get fired. And analysts, because they work with brokers, they have a tendency to offer buy recommendations more than they offer sell recommendations, because when you offer buy recommendations, it can attract more clients so that they can earn more commissions. So there are a lot of conflict of interest that you don't see as a retail investor. So make sure to do your own research, and also make sure that the stock, when it crashes, is below the intrinsic value of the company, meaning the real value of the company. If you're a trader, put in simple terms, intrinsic value is just the target price of the stock. Make sure there's a good level of margin of safety, minimum 50% to be safe. And if you're a dividend investor, not only do you gotta make sure that the company has good fundamentals, but also look at two more extra things, which is dividend yield and dividend payout ratio. Now, dividend yield, make sure that it generates an ROI that is more than your fixed deposit. To be safe, minimum 3%. The next thing, you're gonna look at the dividend payout ratio. Now, this is the percentage of profits that companies pay out as dividends to shareholders. Doesn't mean that the higher the dividend payout ratio, the better, because when it is too high, then a company will not have enough funds to invest back to their business. Hence, it's not sustainable. The stock will not grow too much. So make sure that the dividend payout ratio is not too low too. Otherwise, you wouldn't get a lot of dividends. If it's too high, it is not sustainable. So make sure that the dividend payout ratio is less than 60% to be safe. And one last thing that's most important, that a lot of investors are not willing to do. And some people, they are willing to do it, but they have no time because they have kids. One full-time job, one part-time job, 2 dogs to take care of, so it's like no time. And that is to learn as much as you can about the stock market. Yesterday I was reading this book, okay? And there was this amazing, inspiring story about this investor called Anne Geber. Let's call her Anne. Now, when Anne passed away, she donated more than 22 million to charity. That's a lot of money. And she started with only $5,000. That is inspiring, but the most inspiring thing is that she started learning about stock investing only in her mid-40s. Because previously, she was a tax auditor, something like that. So she had a full-time job. So how did she learn investing? Even back then, she doesn't have a lot of money to buy books, courses. Are there courses back then? So how did she do it? And spend the second half of her life studying shares and making investments in the stock market. She would keep herself informed by reading the Wall Street Journal in the library instead of buying it, and by studying analyst reports on companies supplied by her broker. She also went to all the shareholders' companies' annual meetings and often queried the CEOs to compare notes with the analyst reports she had read. If you don't have money, make the most out of the available free resources that you have. Unfortunately, a lot of people don't value free stuff nowadays. In fact, a lot of people, last week, they asked me to give them a free laptop. 20 people asked me to give them a free laptop. A lot of people are not only not appreciative of free stuff, but they feel the world owes them everything. Be like the top 10%. Put your head down. Learn everything that you can about the stock market. And eventually, the markets are going to reward you. Because markets reward those who are disciplined, patient, and those who refuse to follow the crowd. Okay, with that, I'll talk to you in the next video. Bye.